Just this morning, I got the notification on my Wall Street Journal app that the 30-year mortgage has crossed 6% for the first time since 2008. 6.02% it hit. Now, guys, this is the chart showing the last 14, 15 years of the 30-year mortgage. I mean, yes, there's absolutely, and then boom, skyrocket. So we're going to talk about mortgage rates, but I want you to stay a little bit longer in the video because I want you to hear my comparison of mortgage rates and how it applies to margin of safety and how it applies to how you should view all your investments, because this is extremely relevant for everything we discuss on this channel. So if you're new to this channel, I'm Paul. I'm a value investor. My goal is to look at the long term and find when I think today's price on an asset is far below its long-term value. There's going to be a lot of fluctuations in prices on everything based on the emotional reactions that people have. Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. You've heard that from Warren Buffett. And what that means is in the short run, the popular ones are going to be driven up. The unpopular ones are going to be driven down. But in the long run, what matters is the long-term earnings and free cash flow and the fundamentals of the business. So if you pay a reasonable price for the business today, as the business gets better, because you're buying a piece of a business when you buy a stock, as the business gets better, your asset should go up in value. Now, when it comes to mortgages, this massive increase right here, this is big, guys. And very common question I get in our community of like-minded investors that we have up here in this community, one very common question I get is, Paul, do you think a housing crash is coming? And I'm not going to mince any words. I have no idea because of this. From 1975 to 1984, home prices went from $32,000 per home to $85,000 per home, almost triple over a 10-year period. But in that time period, we had massive inflation and we also had a massive increase in interest rates. At one point in that 10-year period, the average 30-year mortgage was north of 15% per year. That means if you bought a home and you had a $200,000 mortgage, just in interest charges, you had $2,500 per month just in interest, paying down no principal. And why did they do that? Well, when inflation's high, you've got to decrease demand. How do you decrease demand? Well, the Fed will raise interest rates to decrease the demand of products. That way it slows the economy down and slows the prices of goods down. But what does that mean for home prices? Well, that's what we have to figure out. How does that apply to today? Guys, a year and a half ago, my fiance bought a house and she got a 30-year fixed at 2.625 interest. That same mortgage today is pretty close to 6%, just a year and a half. When you have such a sudden shock to the price of something or to the price people have to pay, that should drive down prices. And we are seeing a decrease in demand and an increase in the number of people discounting homes. Home builders are very worried right now. It is a reality that when you have a $300,000 mortgage and your rate goes from 2.6 to 6%, you're paying almost 3.5% higher. On a $300,000 mortgage, that's $10,000 increase in your cost per year. And for somebody making $100,000 to $120,000, that is a big chunk of your after-tax pay. That directly affects how much home you can afford. But inflation has been high, and inflation is the friend to real estate. Now, I don't know how it's all going to shake up. I have no idea. Just the other day, inflation came out and it was worse than expected, and they're now talking about a 1% increase in the Fed funds rate coming up. That would be the biggest increase since the early 80s when we had those 15% rates on mortgages. That is definitely something to consider. I think all day long, we're looking at 0.75% increase in the rates. There are other expectations that now we're around 2.25 to 2.5% currently on the Fed funds rate. There's a lot of people saying it'll be 4.5% next year. That's doubling from today. It was 0% just a year and a half ago, or pretty close to zero. And I look at that saying that is definitely going to change people's behavior of buying. But if inflation keeps going, and if you own a home, then you might be okay with that. Well, how does inflation increase the price of the home? Well, very simply. When you build a home, labor is involved and materials are involved. And what's inflation? It's an increased cost of materials and eventually labor. So if you have a home that you paid $300,000 for, and that home now costs $500,000 to rebuild, exactly, your home ain't worth $300,000 anymore. Your home is worth way more than that. Is it $500,000? Maybe not, because if you could buy a brand new home for $500,000, why do that? So how does this apply to margin of safety? Well, I'm glad you asked, because if you know me, you know how much I discuss margin of safety. It is the absolute tenet for value investing. That margin of safety is, I don't know everything. So I want to buy at a discount to value. That way, if I'm wrong, if I have a high enough margin of safety, even if I'm wrong, I probably won't lose a lot of money and I could still actually make money. So when it came to mortgage rates, if somebody had come to me last year and said, Paul, 2 years ago, I want you to buy a mortgage company, I would have said, guys, that's great. Rates are at historical lows. If I'm a betting man, I don't think you're going to be like that for the next 5 or 10 years. So if I did a margin of safety that was adequate, I never perceived this shoot up. I don't know many people who thought that rates would go from 2.6 to 6% in 1.5 years. But if I had an ample margin of safety, I could have better absorbed this big increase. And that's the key to margin of safety. When you look at your investments and when you look at the companies you want to buy or any sort of investment you want to make, you want to sit there and say, what is my margin of safety? If you're buying a home and you think you're going to live there for the next 3 or 4 years, that is not ample margin of safety to buy it today based on where rates are going and where the economy is. But if you're going to buy a home and you're 40 years old, you have 3 kids and you need a home in order to have the rest of your life, your margin of safety is ample. Why? Hey, I'm probably going to be here the rest of my life. Is there a chance I move in 10, 15, 5? Sure. But if you're already planning to move in 2 or 3 years, then your margin of safety isn't adequate. And that's the key for all investments. Everything you do having to do with even life. You put a seatbelt on your car, that's a margin of safety. Why? Because what are the chances of you actually being in a car accident? Very slim. But if you just do this, very simply, you greatly increase your chance of surviving that one-off fluke accident. It's no different than anything else you're doing in this world. You should put margin of safety in everything you do, including investing. Now, you might sit there and say, well, Paul, this is a fluke. You're right, it is a fluke. But go back and look at the history of the last 20-some years. How many fluke incidences did we have? Remember, 06, 07, by then, no time in our US history had home prices across the board fallen as a nation. And it happened for the first time. There were fundamentals behind that. But if you bought with ample margin of safety, you could have avoided those disasters. Same thing here. And I encourage you to do that every single day with everything you do having to do with money. Why do you live within your means? Margin of safety. If I told you right now, if I'm God and I came down and said, hey, listen, Bill, here's the deal. You're going to make 100 G's. And you're going to make $65,000 after taxes the rest of your life. And guess what? You're never going to have to worry about money if you spend every dollar of it. Then go spend every dollar of it. But there's a reason why you have margin of safety. There's a reason why you live below your means, because some things will happen that you don't know. And the same thing applies here. These mortgage rates, I never thought they would jump up this much. I bet you're hard pressed to find many people, but I'm not trying to figure out where mortgage rates are going to go. My goal a year and a half ago was to say, you know what? I just don't think mortgage rates are going to stay this low forever. Mortgage rates are just like everything. There are cycles, just like that. Now, my brother upstairs said to me yesterday, we were talking about refinancing an apartment building. He said, Paul, well, my concern is, what if we get the interest rates of the early 80s? I said, yeah, what if? And we had a conversation about it. Now, do I consider that? I'll be honest with you, I don't consider 15% interest rates because I don't think that is within a spectrum of reasonable possibility. But I didn't think 6% a year and a half later was in the spectrum of reasonable possibility for interest rates for homes. But we have the conversation, we discuss it. Okay, if rates go up to 15%, what happens to our rents? He's like, well, that's a good point. I was like, inflation's probably pretty high. Rents will be driven up. We've already seen a 21% increase in our collections in our apartments in the last year because of inflation. 2, less people are buying homes at 15%. What happens then? They get to rent more. So what are they doing? Rents are going up even more. So it'll be probably a temporary problem for us, but as long as we have our ample cash flow and we spend within our means on those apartments, we will be fine. So this is like when people tell me, Paul, are you a real estate guy or you a stock guy? I don't look at it that way. I'm an investor. I look at all investments the same way. I got a request in our community just today to evaluate a copper business. And I sat there and said, listen, I'm an investor. The way I look at it is copper prices fluctuate. And when I look at the stock price and the earnings of this company, it fluctuates with copper prices. So I need to assess copper prices. And the way I looked at it was copper prices are probably high compared to history. So I factor that in there. These are all the things we do. But it's especially applicable today because of the sudden rise we've seen in interest rates. It is a wonderful learning lesson for the future. And that's what I want you taking away from this video. So if this makes sense to you, it's absolutely important that you watch the next video where I describe more about margin of safety, and please subscribe to this channel. Thank you very much for your time.